Okay, so guys, we're going to start with the next topic on money market instruments. In this particular chapter, we'll be dealing with how do you tackle something called the repo transactions, and then commercial papers, and the T-bills, that is treasury bills issued by the Reserve Bank of India to raise money for the government. Now let us now take on, first understand the meaning of repo transaction. Now what exactly is a repo transaction? Just see the screen. It is nothing but a repurchase agreement. Now how does it work? I'll tell you. Now let us say there are two bankers involved. Let us say my right hand is a bank A and my left hand represents bank B. Is that fine? So bank A, how are you? Okay. And this bank B, how are you? Fine. Now what happens is, let us say bank A is in need of money because they have to pay some depositor immediately, but they do not have liquid funds. Now, what does bank A do? What they can do is, they can enter into something called the repo trade or repo transaction with banker B. How does it work? I'll tell you. Now, let us say bank A has these investments, the bunch of papers. Fine. Now, these are nothing but investments held by banker A. This can be even investment in some government bonds. Now, what a bank A can do is, they can take these investments. Let us say these investments have a market value of rupees 1 lakh, for example. So, bank A can take these investments and sell these investments to banker B. Got it? Today. But banker B will not lend rupees 1 lakh to banker A. Banker B will buy these investments even though the investments are valued at rupees 1 lakh. That's a market value. Banker B will take a 2%, that is, will reduce 2% or 1%. In our example, let's take 2%. That's called the margin, or you can say the banker A has to take a haircut. Now, what is haircut? Even though the investments are worth rupees 1 lakh, banker B will not give rupees 1 lakh, he will give only 98,000 after reducing 2%. It is nothing but, please remember, after giving this 98,000 rupees, on the same day, banker A will enter into one more agreement with banker B to repurchase these investments, let's say in 30 days for rupees, let us say 1 lakh and 1,000. Got it? That means on the same day, banker A enters into a repurchase agreement to repurchase these investments from banker B for how much? 1 lakh and 1,000. Now, when is amount fixed? Today. Got it? Now, please remember, it might look like as if banker A sold investments today and is going to purchase investments after 1 month. But please remember, it is actually a financing arrangement. It is not a sale at all. And this is a stand taken by Ind AS number 109 on financial instruments. So you will learn in Ind AS 109, there is a section on when to derecognize a financial asset. So banker A should not remove this investment from the books, even though it is sold to banker B, because all the risk and rewards, even if the investment goes down to 95,000 in a month, still banker A has to pay 1,01,000 and repurchase these investments. Is that clear?
Yes.
Got it? That means you can say that all the risk and rewards, even if the bonds have a value, the investment sold has a value after a month, let us say 1,10,000, still banker A has to pay only 1,01,000 to buy those investments back. So if you look at this, it is a financing arrangement. It is a sale, that is sale and a repurchase. Banker A is going to sell those investments today and repurchase the same investments after 30 days for rupees 1,01,000. Now, note this point. On day one, when the investments are sold by bank A to bank B will give 98,000 loan against investment worth rupees 1 lakh. What is rupees 2,000? That is supposed to be the margin or the haircut. Even though the investments are worth rupees 1 lakh, banker B reduces 2%. What is the reason? Suppose bank A fails to repay the loan in 30 days time, banker B can sell these investments for rupees 1 lakh and at least recover rupees 2,000. Loan given is 98,000, recovered 1 lakh, net 2,000 return. Got it? And that is the reason bank B charges something called a haircut. Got it? That is a margin charged by the banker for giving this loan. So basically you reduce, even though you banker A comes with rupees 1 lakh worth of investments, bank B will not give 1 lakh, they'll give only 98,000. The 2,000 to safeguard banker B, in case the bank A is going to default, in case they make a default, the 2,000 will protect the banker giving the loan, that is bank B. Now, what is the entry in the books of bank A? Think about it. When they got 98,000, the entry will be in the books of bank A, my right hand, will be bank account debit or cash account debit to loan from bank B. How much? 98,000. That is the amount borrowed against the investments given as a collateral, as a security. Got it? And after 1 month, when banker A is going to pay 1,01,000 and get these investments, what is the entry? It's going to be loan account debit. How much? 98,000. Interest account debit 3,000. To cash or bank account 1,01,000 repaid. Got it? That is how a repo transaction works. Nothing but a repurchase agreement. Now, having this understanding, let us walk into this example. And this is not from your study mat. It is an extra question. That is from May 2016 RTP. It is an example on repo, that is REPO, that is a repurchase agreement. Got it?
Yes, sir.
And a very similar sum is there in your study mat as well. Now, I'll just, after discussing this particular example, okay, then I'll take on that example. So, here we go with
Bank A enters into a repo for 14 days with Bank B in 12% GOI bonds 2017 at the rate of 5.25% for 5 crore rupees. Assuming that the clean price is 99.42, initial margin be 2% and days of accrued interest be 292. You are required to determine the dirty price, start proceeds first leg and repayment at maturity second leg. Assume number of days in a year as 360.
Now listen. Now please understand bank A, my right hand, and bank B, my left hand. Okay. Now what happens? Banker A wants a loan. and bank A is ready to sell their investments. What investment? These are, assume these are investments in government bonds. And what is a face value given? Rupees 5 crore worth of bonds, right? Now face value per bond is not given, assumed 100. Now what is rupees 5 crore by 100? That means there are 5 lakh bonds. Banker A is ready to sell 5 lakh bonds. At what rupees? Now what will be the price, or what is the market value of these investments? You have to find out. It is given that the clean price of these bonds is rupees 99.42, right? And that is a clean price. But please remember, the market value of a government bond will be just not the clean price, which is X interest. Please add even the income accrued on the bond for the last 292 days, right?
Yes, sir.
So please add income accrued for the last 292 days. The market value should be always equal to the clean price plus the income accrued on the asset for the last 292 days. And that is called the cum interest or dirty price. That is a true market value of these investments. So how to find the dirty price or the market value of these investments, including income accrued on the asset? Very simple. Just see the calculation out there. You take the clean price rupees 99.42. Is that clear?
Yes.
Plus rupees 100 face value, and on that 12% is a rate of interest on these government bonds. You all know this, always interest income is calculated on the face value of a bond, right?
Yes, sir.
So 12 by 100, 12%, for how many days? For 292 days. And 12% is a per annum rate for 360 days. So into 292 by 360, you get the interest portion, and add both. In all, you get rupees
109.1533.
That's supposed to be the dirty price or the market value of these investments, including income accrued on these investments, right? It is rupees 109.1533 per bond. Got it?
Yes, sir.
But very clearly given bank B, the initial margin given as 2%. That means bank B will not give you rupees 109.1533 for every bond you sell. They'll give only 98% of that. Got it?
Yes, sir.
Now what you can do is, now the first step, that is stage 1, that is start proceeds. That means when bank A is going to sell investments today to bank B, how much will bank A get the proceeds? Very simple. There are two ways of working. Either take 5 lakh bonds, 5 lakh bonds will be sold at 109.1533 into 98% of that number. Got it?
Yes, sir.
Or what he has done, rupees 5 crore into 109.1533 by 100 is as good as 5 crore rupees divided by 100 face value will give you 5 lakh bonds are sold at 109.1533 into 98%, because banker B will not give all the 109.1533 to bank A, they will remove 2%. Got it?
Yes, sir.
That is what is captured. That means what is a loan given by bank B to bank A? It is 5 crore
34 lakh 85,000.
85,117
117.
has been rounded down to rupees 5 crore 34 lakh and 85,000, right?
Yes, sir.
That is a loan given by banker B to banker A. Now, what is a entry when the loan is advanced? Just see the journal. Can we go to the journal?
Yes, sir.
Stage 1 journal. The entry will be, it is a bank account debit, or you can say cash account debit. Money comes in the books of bank A. Then 2, loan from banker B, which is a financial liability. Is that clear?
Yes.
Then let's go to the second stage. That is after, it's a 14-day repo. After 14 days, bank is going to repurchase those investments. How much should they pay for that? And that repayment amount, that is repayment at maturity after 14 days, will be the amount that you borrowed, that you guys means banker A borrowed, which is 5 crore 34 lakh 85,000. And on that apply 5.25% per annum rate. That into 14 by
360.
360. You can get the amount of interest alone. How much? 1 lakh?
9,199.
Then added to rupees 5 crore 34 lakh 85,000. So you get the amount to be repaid. Or what you can do? You can take the amount borrowed into 1 plus rate of interest. That's what they've done. It is 5 crore 34 lakh 85,000. That into, the in brackets, that is 1 plus, the rate is 0.0525, but that's a per annum rate. That into 14 by
360.
360 is only for that 0.0525, guys. Don't apply on 1. 1 is a principal.
Yes, sir.
Only 0.0525 into 14 by 360 close brackets. Multiply, you will get the repayment amount including interest, which is rupees 5 crore
35 lakh 94,199.
94,199, and that is amount to be repaid. Stage 2. Got it?
Yes.
And what is the entry when you repay the money? Just see the entry. Loan from bank B, nothing but financial liability account debit, and then interest expense account debit, to cash or bank account repaid, cash going out will be rupees 5 crore 35 lakh 94,199. Is that clear?
Yes.
So guys, pause the recording and jot down the example before and also this solution. Is that clear?
Yes.